Morning. Thanks for having me on. Well, we're expecting a 25 basis point hike at this meeting and a 9-0 vote. And, we're looking for a large upward revision in the wage growth profile, given recent indications of sort of strong and sticky wages. And I think that will be the signal that more rate hikes are coming. We're not expecting any direct language indicating likely action in the next meeting or two.
Okay, well then I just want to pick up on that last point Jeff made about fiscal as well, because it's not totally divorced from monetary in terms of the decisions that the Bank of England are going to make. Cost of living crisis, as Jeff was talking there, tightening on the mortgage side of things. Rishi Sunak under the nail on this. So how much is that factoring into the BOE's decision making, and how might that hamper them in terms of giving forward guidance, because they're waiting to see what the government are going to do?
Well, of course, the bank can only factor in legislated and announced government policy, and I think there's an open question given the upward revisions from the monthly fiscal numbers that the Chancellor might have some more headroom and might be able to announce some new policies in the March budget. But I think front and centre of people's minds right now is what the Chancellor announced today. We're not expecting a full offset to the large rise in energy prices that are likely to come through to households in April, but it sounds like there's a significant policy that's likely to be announced.
Can I ask you about market reaction from sterling and from the gilt market? Because of late, I think what we've noticed is the dollar's been very much in the driving seat on sterling. And when you look at the shape of the gilt curve, the fact that the Bank of England has been a steady buyer of government paper has really kept the curve very flat. From here on in, do you expect to see, if we do get an announcement on QT today and that the process of running down the balance sheet has started, do you think we get some shift in that flat curve?
Not on the basis of the balance sheet policy. I mean, we're expecting them to hit the 0.5 threshold and announce today that they're ceasing reinvestments going forward. I mean, there is the question of the large 28 billion gilt redemption in March, but we don't think this is likely to have a large market impact. I think what is more important is when they come to active asset sales, and we don't think they get to that point until later in the summer. We've penciled in 20 billion a quarter of active asset sales. When you add that to natural runoff, you get to around 100 billion over a 12-month period. And our rule of thumb suggests that that would be about 10 basis points in rate hike equivalent. So, some impact on financial market conditions, but less than half a rate hike. So not anything substantial there.
The market assumptions on interest rate hikes are largely based on, I think, strong underlying recovery from the Omicron crisis. Any reason to be a little more circumspect on some of the labour data trends, and perhaps to reflect on just where we are seeing some limits on price pressures, namely in technology?
We're very constructive on UK growth, and the last few labour market reports have come in some ways surprisingly strong given the end of furlough. There's very limited evidence of significant disruptions from the end of the furlough scheme. I think one risk for growth momentum going forward is something that was discussed earlier in the programme, is the cost of living crisis, and we have a decelerating profile for our quarterly growth over this year, but we don't think that's enough to totally stall a recovery. We think that the fact that services spending hasn't made up the shortfall relative to its pre-pandemic level, and the high buffer of savings, particularly in the middle to upper income deciles, should push the economy through and allow the momentum to keep going.